Well, hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is February 2nd, Groundhog Day of 2023. So thanks for joining us for our market insights and observations. Let's get right down to the three topics we're going to highlight today. We're paying attention to as markets are, so you should be too. So thanks for joining us. Our three topics today, let's start off with yesterday's Fed meeting. They kicked off the two-day meeting, concluded with a 25 basis point increase to the Fed funds rate and bringing us well closer to the 5% mark. Not quite there yet in terms of Fed funds, but it just shows that the Fed is slowing, but they're not stopping. In fact, we're going to talk about that, and we're going to continue to talk about what the dollar is doing and how it's actually helping U.S. corporations here, and also some international corporations as well, as the dollar has peaked, at least in the last few months. And then the Fed are they turning a corner? Let's talk about that. Let's talk about the peak dollar. The question mark is, we've seen the dollar fall back about 9% since September. Let me do this right here. Highlight it for all of us at home. And right here, 9% since September, and that's what we've been seeing. So ultimately, international stocks have outperformed and emerging markets since then. Breach of the 200-day moving average on the downside. And the key reason is a risk on sentiment due to a better U.S. growth and moderating inflation in the U.S. We're also seeing the ECB lightening up in terms of their tightening measures. And Europe has basically averted an energy crisis. Remember, we're all anticipating, because of the geopolitical and the war that's going on in Ukraine, that as they get through, the European winter, the energy crises seem to be averted. So there's a lot of relief right there. And so that's where we're seeing some downward pressure on the dollar. Now, shifting gears here to the Federal Reserve, as expected, the Fed downshifted again, back down to 25 basis points. Keep in mind they did 75 a few times back in a row. Now the Fed funds target moved up to 475. And this is the first time that we saw a 25 basis point hike since the kickoff of the Fed cycle last March, and it's only been March. And so as we saw, I already used this same chart in previous videos earlier on, but we're right here right now, and the Fed potentially could be, these are all the previous pivoting and pausing cycles in the past, going back to 94, 2000, 2007, and 8. Obviously in 2020, and then right here in 2023. We don't know how much further they're going to go. We anticipate maybe another 25 basis points, but keep in mind they have two more, a lot of economic data that's going to be reported between the next 3 or 4 weeks since their next meeting, and they got 2 employment reports they're going to see. So we see that there are some of the highlights of the commentary yesterday, and our take is ongoing increases in target range would be appropriate, meaning they're going to wait and see. They're going to look at the lag effects, as we talked about before. So the also in our take is the Fed is committed to achieving price stability and taking full force action to date, and also acknowledging that the lag effects or the previous rate hikes have yet to take full effect in the economy. And so there's more work that needs to be done on an ongoing basis and necessary to maintain a restrictive stance for quite some time. But we've heard all of that before, and that's why the market took it in stride and actually rallied as a result of that. And it's gratifying to see that disinflationary progress is now getting underway, and it's continuing to get strong labor market data still. So that's kind of the sticky period. Like the JOLTS report, remember the job openings versus the unemployment. There's a gap right there that the Fed's trying to work on. If you watched before, this is the one I keep bringing up. That's what the Fed's watching before they slow down on their interest rate, or essentially pause in this case, moving forward, because they're going to continue the 25. At least that's what we expect right now. So the base case on the economy is waiting for the 2% inflation. Looks like we're at 4% right now, just over 4%. And that's good, welcome news, but we still have work to do to get to the 2. And that'll be fully incorporated in their policy thinking. But the reality is, and the bottom line here is that the disinflation process has clearly started in the Fed's eyes, and they acknowledge that. That was key. But they don't want the volatility of the stopping and starting and the hiking and the cycle to continue, adding stress and depending upon the dependence and the flexibility of the Fed to stop and go again. So they're going to stay slower until they need to pause, and they're going to stay higher for longer. That's essentially what we're going to see from them. So all options are on the table. This is the green part. This is the good sign. All options are on the table. And this is what Powell said, including a pause and further adjustments are needed. So there we go. We got that in the language for the first time ever. And again, that's why we saw the markets rally yesterday and continue as well today. So the Fed is trying to at least communicate to the markets that they're not going to blindly continue this hawkish path. They're going to be realists. They're going to wait and see on the data. So now the next underpinning, as what we're watching, are just the earnings. And earnings are coming in better than anticipated. So we've got sort of that earnings backdrop helping out, again, the equity markets, as we're seeing corporations do a little bit better than expected, over 70%, a little bit outperforming the numbers reported by FactSet right now. So we'll keep an eye on that. But that's your update for today. Thanks for watching. And again, like and subscribe and share it to friends and family because it's free and it's also important to stay in the know. Thanks for watching.